Hey guys, happy Saturday. For my AMC investors, I did tweet this out yesterday, but I wanted to get a video because not everybody's on X. And I see a lot of you asking, why did the short interest drop so precipitously on the bar that is at the far right of this chart here? This massive white candle down, 20 million shares removed from the short interest of AMC. And if we look at the table, you can see that the short interest dropped from 66 million to 45 million, a 31% change, almost a decrease in the short interest. They are reporting that the short interest is only 10.65%. However, I do want to point out that the float they are using is 430 million shares. And we know from AMC's most recent 10Q that the actual float is now 512 million shares. So the short interest is under 9% now. If you use the proper float, under 9% short interest on AMC. In this video, we're going to talk about why did it go down. And yeah, I'm going to also fall on the sword here and talk about that chart that's going around talking about AMC short interest going up by looking at shares, and why that is accidentally misleading people with data. Charts can be used to give you misinformation. I want to make sure I give you the right information, the correct way that any data analyst would look at short interest. So we'll close up this video with that, but let's talk about why did 20 million shares get removed from the short interest and in July. And I am going to remind you that on July 1st, the company did a debt restructuring, July 1st of 2025. And in that debt restructuring, they exchanged some convertible notes and removed, what's it say here, 143 million of debt was taken away in exchange for about 79.8 million shares. Lenders got handed 79 million shares in July. And as you guys probably know, if you've been following any of my content about convertible notes, if you've watched any of them on AMC over the last year, any of them on GameStop over the last several months, any of them on Cinemark, you know that I'll put a link to this document in the video description again. If you haven't read it, you'll want to look at pages, what do we got here? 9 to 11. Unwinding the hedge. When a company has convertible bonds, AMC had a bunch and they just got rid of a bunch. When a company has convertible bonds, the bondholder will, they're on the hook for hundreds of millions of dollars of risk. And they aren't just going to leave that risk unmitigated. They're going to hedge it by going short the common stock. And when debt gets wiped out, they're going to unwind that hedge. So that is how you get the short interest going down 20 million shares. They had 143 million of debt that they didn't need to hedge for anymore. And in addition to that, what else might be causing some shorts to exit? The company pushed the maturity of their debt and resolved the lawsuit. So some of the short thesis that was building up over short term got removed. So again, if you take all of these events and process them logically and unemotionally, it is very reasonable to understand why the short interest went down. And why didn't the price move? Some people are saying because the company gave the shares to the shorts. I mean, this is standard short unwinding, a delta hedge unwinding. They build up this short position to protect their bonds, and at conversion, they take the shares and wipe out their short position. They didn't need to go buy the shares. The company gave them to them. And this is not any knock against AMC. The same thing is going to happen to GameStop. The short interest is going up because GameStop has convertible bonds, and at whatever point they convert, there's no short scared in GameStop if they're holding bonds. they will get free shares from GameStop to wipe out their short position. The same thing is happening right now with Cinemark, which has over 20% short interest, and all of their bonds just matured on Friday. So I want you to watch Cinemark short interest over the next 30 days. And I would bet you're going to see a substantial reduction in the Cinemark short interest because they're going to unwind the convertible bond hedge that they had. And that is how you will know that I'm correct about what is going on here. Right now, this is what I'm seeing. And, a lot of people have been DMing me with other theories related to swaps and other things. Look, there's several logical reasons to understand why the short interest decreased. The other thing that I want to talk about, and I know this is not going to be a popular topic, I get it, but nobody likes me anyway. So when we look at short interest, what do we look at? Do we look at the number of shares shorted? No, we don't. We look at percentage of the float. Every report that you see is a percentage of the float. It's the first column right here. Why is that? Because if you're looking at just the raw number of shares and the company is actively diluting and the float is going up 10x over the last 3 years and the shorts are wanting to maintain the same percentage of the float short, of course, the raw number of shares is going to go up. It is irrelevant to the price of the stock. They're not shorting more because the price is lower. They're just maintaining a percentage of the float short that if you're a short and you're looking at risk, they're comfortable shorting 8, 9, 10, 15% of the float. And on top of that, we have convertible bonds. And so there's some shorts in AMC because of the existing convertible bonds. That's just how it is. And same thing with GameStop. There's shorts in GameStop because they're hedging their convertible bonds. They want a delta neutral hedge so they can profit from gamma trading. Same thing happening in Cinemark. I get the excitement to try and convey something to someone in a new and novel way, but short interest should be considered as a percentage of the float. And if you're looking at it in terms of raw shares, you are going to mislead yourself and you are going to mislead others. I'm not here to do that. I'm here to keep things unbiased, unemotional, and as fact-based as I can. I'm a guy with a finance and economics background, a career in engineering. I like numbers and I like presenting the numbers accurately. So I am sorry. I'm sorry if me conveying my opinion about how to properly read data hurts your feelings. But in my opinion, the message that was put out last week about looking at the short interest by number of shares is very misleading, probably unintentionally so, but I am not in agreement with that. And I think it's going to lead you guys to make bad decisions if that is how you're looking at the data. Look at short interest as a percentage of the float, and you will have a common sense way to look at it. Remember that the shorts want to maintain a percentage of the float, and if the company is diluting, they're going to add shares. That's all it means. Percentage of the float. If you guys have any questions or comments, leave them for me down below. I am Tony DeNaro, and I will see you on the next video.
So you wanna go to war with me?